CashCalc is quite unique in the sense that it has two cash flow modelers, a net modeler and a gross modeler. The net modeler is the simpler of the two, often seen as a great way for beginners to understand cash flow and create some basic forecast. And as the name suggests, it expects users to input all figures net of tax and therefore won't provide any sophisticated tax calculations. But it is a great way to help beginners learn how cash flow works and create some really useful client cash flows. Incidentally, it's also a perfect tool for advisors working with offshore clients who won't be impacted by UK tax and might need to build in some bespoke costs and charges to help calculate any offshore taxes being paid. Now, gross, on the other hand, is much more sophisticated, and users can input all figures gross of tax. All tax rates and bands are hard coded, so the modeler will automatically apply the correct taxes and arguably create a more accurate cash flow. Gross is now the more popular cash flow modeler out of the two. So this video will explore what the forecaster is capable of and how it differs to the net modeler. Now, first and foremost, how do I access the gross modeler? Well, every time you're asked to create a cash flow on CashCalc, it will ask you whether you want to do this on a net or a gross basis. So my example here, I've got Keith and Barbara Baker. I've loaded up them as a client. And when I click on cash flow, I've got the option to look at all of my cash flows that are built under net and all of my cash flows built under gross. You'll notice every single time I click on create a new forecast, this screen will always allow me to flip between whether I'm doing this on a net or a gross basis. If we load up a gross cash flow, if we load up this example one, you can see that the UI and the user experience looks a little bit different to the net modeler. You can see the cash flow itself. There are three options. You've got savings over time, which again is the same as the net modeler. You've got money in, money out, showing all of the money coming in and all of the expenses illustrated on one cash flow. But because we can work out all of the taxes on the gross modeler, we now have a taxes tab, and it will clearly show you all of the taxes being taken. So pre-retirement, you can see there's quite a few taxes for this client. This is the income tax that's paid by Keith. There's the NI contributions of Keith. There's a small slither of capital gains tax that Keith is paying on a withdrawal he's making from a GIA. And there's the income tax paid by Barbara, his wife. And there's the NI contributions Barbara's making as well. Now, you'll see on the left-hand side, there are five core parts to the gross cash flow: inputs and timeline, cash flow model, stress testing, yearly breakdown, and create report. Inputs and timeline, as the name suggests, are all of the inputs. So we'll focus on this heavily throughout this recording. We're just going to go through each one of these options and explain again how this differs slightly to the net modeler. So the assumptions tab to start with, again, like the net modeler, it allows you to dictate when that forecast comes to an end. So at the moment, we're going to suggest that the forecast default to the age of 100. Unlike the net modeler will only have one rate of inflation it needs to consider. Because the gross modeler takes into account the triple lock, we need these three different rates. So CPI, RPI, and average earnings increase. So again, we default to 2.5, 3, and 2.5. It's entirely up to the user to change that if they need to. Like the net modeler, you can also dictate how much surplus income is being saved to that current client account. But unlike the net modeler, you can also dictate whether any surplus income doesn't necessarily just go into the current account, but it goes into a different pot. So let's just explain that in a bit of detail. So if I come down to my cash flow model here and go to savings over time, actually let's start with money in, money out. You can see pre-retirement, there's a lot of income coming into this cash flow, and the expenses, that dark solid line, expenses is around about 41,000 every year. Now, husband's salary is that one, 48,000. Wife's salary is 35, and they've got the extra 9,000 coming in from the GIA as well. Now, what's happening with this surplus income that's coming in that isn't being spent with any kind of complementary expense? If I go to savings over time, you'll see exactly what's happening with it. It's just simply bloating the current account. So any excess income coming into my client's cash flow is just being stored in that current account. It's growing and growing and growing. And then on retirement of that client, that's the first pot to be spent. And it just gradually gets spent over time. And the clients start eating into their existing traditional assets. But there will be a time on this particular cash flow pre-retirement where that current account has swelled to about 300,000. Now, is that realistic? Although technically there is a surplus, realistically, that's probably not going to be saved. A lot of that is going to be spent on maybe some holidays, maybe some gifts for children or a wedding, etc. So rather than me having to go into inputs and timeline and create an expense to basically get rid of all of that surplus, what the net and the gross modeler allow you to do is simply dictate here how much of that surplus is being saved. So I can very quickly decide that actually 0% of that should be saved. And then if I click out of that, that will save it. If I go to my cash flow model, that you can see that the surplus is still there. But when I go to my savings over time, suddenly that's got a lot more negative, and you can see that it's just disappeared. It's just assumed there's a subsequent expense. So all of that surplus income has vanished, and therefore the cash flow is now actually running out of money, whereas it wasn't beforehand. It's now on minus 56,000 by the time they both reach 100. Now, what the gross modeler allows you to do on top of the net modeler, the net modeler doesn't have this ability, is it allows you to A, save a percentage of that, but B, allows you to contribute to a different pot other than the current account. So actually, maybe the clients decide that 80% of that surplus income will invariably be spent, but they're going to make an effort to try and save maybe 20% of that, and that's going to be added contribution into Keith Baker's pension. So that's now updated successfully. If we go back to my cash flow modeler, you can see suddenly there's now a positive at the end of my forecast because 20% of that surplus income is now being saved into this pension. And if we go to my yearly breakdown, if we open up one of the early years, you'll see this quite clearly. If we go down to liquid assets, if we scroll down to my pension or my client's pension, you can see that surplus income coming in here as well with the tax relief as well. So yes, in total, an extra 13,000 being saved into that pension because of that surplus income is being directed in there instead. So that's a useful additional feature on the gross modeler. People and timeline looks a little different to the net modeler. Obviously, because this is a tax modeler, we need to know the country of residence, where that client is domiciled in England, Scotland, Wales, and Northern Ireland. And again, the correct tax rates will be taken as a result. We also need to know if any lump sum allowance, LSA, has been used before the forecast starts. If it has, you can put it in there. You can signpost whether the money purchase annual allowance has been triggered as well before the forecast starts. You can, again, just signpost or tick that on or off. And again, based on the client's age, are they eligible for any marriage allowance? So if so, you can specify the clients are married, and therefore the marriage allowance will kick in if applicable. So that's people and timeline. If you select savings and investments, this differs quite a lot to the net modeler in so much as you've got to specify the type of pot you're adding so we can take the right allowances and the tax rates. So if you click on add savings and investment pot, give it a description, categorize it as either cash, ISA, GIA, onshore, offshore bond, unwrapped investment, or other untaxed. The input fields are obviously going to differ depending on what you select here. So we can categorize this one as cash, who the owner of that pot is. Is it Keith? Is it his wife, Barbara? Is it jointly held? Again, that would change the tax calculations in the background. So we're going to say this pot's owned by Keith. What's the starting pot value? 100,000. The total return, the expected growth of this pot is going to be 3%. And then underneath there, I can specify of that 3%, how much of that is going to be interest income. Well, it's cash. So again, dividends has been cleared out or grayed out. So we're expecting the whole lot to be interest income. And then I get to decide whether that's reinvested back into the cash account, or whether that's going to be the 3% is reinvested back into the client's current account to be spent first. You'll notice if I now change that to ISA, some of the options change. Again, I can specify a particular owner and a starting pot value. Total return, again, very similar to the net modeler. If you specify a particular return, you can either do it on a deterministic input, say I expect this pot to grow at 4% every year for the rest of the forecast. If you select template, these are the templates you've built yourself in CashCalc. Or probably the most popular option, you can import them directly from your analytics account. So any portfolio sitting in analytics, I can pull that through here, and we can say that this ISA relates to the Wealth Select Managed Passive Portfolio 7 in analytics, the MPS solution that we're going to be using, and it will pull the asset allocation from analytics into CashCalc, and it will dynamically, automatically create a growth rate for you, in this case, 716. If we choose GIA instead, obviously there's some significant tax implications of the GIA, notably CGT. So again, specify the owner. What's the original investment? Maybe to date, that client's invested 50,000. So straight away now CashCalc knows how much gain has been made. Again, the same total return field as before, and a bit unlike cash, the income field at the bottom has now changed. So you've now get the option of doing and or interest or dividend payment. So out of that 7.16, how much of that are we expecting to be generated via interest income or dividend income? And maybe it's 2% of both or just one or the other. But again, always the option of reinvesting back into the GIA or paying into the current account, the income that is. The onshore and offshore bond, pretty much identical input fields, but obviously, again, the tax implications under the hood will differ depending on what you've selected. So who the owner of that pot is, who the lives assured, again, similar to the GIA, the original investment and the starting pot value, across how many policies, perhaps this is over 10, a commencement date is needed. And then you can add in as many previous withdrawals and as many previous top-ups as you like, so that any ad hoc payment from this pot, we can work out the chargeable gain for you. And again, the same total return field as before. And then finally, at the very top here, you've got the ability to add an unwrapped investment, which works very similar to a GIA or maybe another untaxed pot, maybe like a NS&I premium bond. Very much like the net cash flow, you can also set a liquidation order as well. If we come back to my cash flow model, you can see the liquidation order at the moment is once the current account has been spent, then you've got the bond being taken. So the bond gets spent first, then the ISA gets spent there, and then it's the NS&I premium bond, and then the pension gets starts being taken at the age of 74. Like with the net and the gross, you can change the liquidation order. So you can change maybe that you want the pension to be taken first, or maybe the GIA at the top to be taken first. Now, clearly, if you put in any withdrawals, that will prioritize those over anything else. But under a set pot liquidation order, I can select that. I can say maybe if I want the pension to be taken first, I can just simply drag that to the very top. But I'll just keep it where it is at the moment. So again, the same with net and gross, you can change the liquidation order however you like that to be displayed. If you click on the pensions tab, there's quite a few notable changes to the gross modeler compared to the net. The net also has the state pension available in there as a quick add, so I can just simply click on state pension. It will automatically assume the top rate. You can obviously change that if necessary, and then obviously signal husband or wife. So that's the same as net. The big differences with gross, though, is add DC pension, add DB pension. So we separated them with the DC pension, give it a description, signify who owns that pension. You can then flag whether it's an inherited pension. So if it is inherited, you can then specify whether all of the income taken from it is going to be tax-free, whether it should be taxed at the marginal rate of the client. If it's not inherited, it will give the option of selecting whether it's fully uncrystallized. And if it's not fully uncrystallized, you can specify how much of that pot is crystallized, is uncrystallized. Specify the growth, again, same as the other investment pots. And again, any income now taken from that pension, it will know how much of that to tax and what tax rate to use. With DB pension, this will very much depend on whether it's an active scheme in payment or deferred. So you can signpost whether it's in payment, deferred, or active here. In payment's the easy one. I can just simply put in a value, and again, we'll take the marginal tax for that client of any income coming in for that particular DB income. If it's a deferred scheme or an active scheme, we're going to need a bit more information about the scheme itself to be able to calculate the DB income, when it's going to get paid and how much of a lump sum. You can signpost again whether it's a courier average or final salary. And this additional scheme information can be included here, the accrual rate and the commutation factor, etc. So that's for DB incomes. Let's come back to this main screen. Incomes, as well as had some notable differences. If I click on add income for any client, I can specify whether it's an employment income or other income. If it's an other income, you just need to specify whether it's taxable income or non-taxable. And if it is taxable, specify whether it's earned income or dividend income. If it's employment income, it's only really going to be one of three. So we can specify again an owner of that income, and we're going to say it's an employed income, self-employed, or company director, and the options underneath each one of those will obviously change fairly significantly. So perhaps the employed income for this client, the client earns 70,000. You can also specify whether the client's part-time or not. We can also input any bonuses being paid, any benefits in kind. You can also add in pension contributions from salary, pension contributions direct from bonus as well. If you click on, say, contributions from salary, you can specify whether it's DC or DB. You can say whether it's salary sacrifice or net pay. Maybe it's a percentage. Maybe the clients pay 6% contribution. You can also include employers' NI saving, yes or no. Maybe there's an employer contribution from the income as well. Maybe that again is 6%. So let's just change that to 6. So you can add in then. You can also add an income change as well. So perhaps with this particular client, they're earning 70,000 now. In the years leading up until retirement, maybe they are going to go part-time and they're going to be maybe on half that. So I can click on add income change. And now we've got two. You've got gross salary 1 is 70,000, and maybe gross salary 2 is 35,000. Incidentally, if I've added a DB income and it's attached to this salary, it's clever enough to recognize that now there's a change in that salary. So if it's a career average or a final salary calculation, it's clearly going to be quite important to know that the salary itself is going to adjust. So again, the system's clever enough to recognize that on the DB income calculation. You can add as many income changes as you like. So as I said at the very start of this presentation, there's a lot of difference between gross and net, and one of the differences is this is a lot more sophisticated, so it expects you to add a lot more into it to be able to calculate the true return of these assets. So that's the income. If we go down to expenses, there's the only kind of notable change here is you can signify the type of expense, whether it's essential, lifestyle, or discretionary. So when I'm adding an expense in here, I can signpost them here: essential, lifestyle, discretionary. So essential would be heating and eating, your core expenses that you need just to live. Lifestyle is obviously to live nicely. So you might have some holidays in there. That would be a lifestyle expense, or just socializing, going to the theatre, etc. Discretionary would be the big expenses, maybe like a wedding anniversary, round the world trip, buying the Aston Martin. So because I can signify the differences, it means that when I go back into my cash flow model and go to money in, money out, that's why I've got two expense lines. One is my essential expenses, which is that one. That's, again, heating and eating. And then all of them joined together is that total expense, that solid black line. Incidentally, with the net and the gross model, you can hide everything, and then you build a bit of a story. So we can say, well, look, Mr. and Mrs. Client, this is your essential expenses. That's what you need to basically just to live. Then your lifestyle expenses to live comfortably, and then your total expenses for everything. So this is what we need to try and uh, meet or match post-retirement. So what does life look like pre-retirement? We've got your salary coming in, Keith, then that regular withdrawal you're making from your GIA, and then the Barbara salary coming in as well. So again, that surplus income coming in, and then how do we meet that deficit met by? Well, that's the bonds. So that's maybe some chargeable gains in there. There's the deficit met by the ISA, and we're going to sell down the premium bonds to cover off some of that deficit, and then it's the UF plus payments coming in thereafter. So that's how we're going to meet all of these expenses to ensure that savings over time, you don't run out of money. So that's expenses. In terms of transfers is quite a new feature. It's very useful, differs to the net modeler. With a net modeler, you can technically make a transfer from one pot to another, but it is quite fiddly. I've got to set up a withdrawal from maybe a GIA into a current account, and then I have to set up a contribution from that current account into the ISA for like a bed and ISA transfer. With this, I can just simply set up a transfer. I can hit the add transfer button. I can say add from Keith's investment account, which is the GIA. I want to transfer that to the ISA, and we're going to call that maybe bed and ISA transfer. I can specify that's going to be £10,000 every year from A date to X date, and then click on add transfer, and it essentially creates in the back end the contributions and withdrawals for you, rather than you having to do it individually. So that's a transfer feature. Contributions is almost identical to the net modeler. The only difference here is these were added automatically. You may have noted when we added in the income for that client, we specified there was a 6% contribution to the employee contribution for the pension and employer contribution. So that's where it's added it for you, 2 line items. So you haven't had to do that yourself. You've been able to do that once you've added the client's income. And withdrawals are, again, very similar. Apart from these quick add options, which are quite nice, you can do PCLS withdrawal and enough plus withdrawal and a flexi access drawdown. Makes it life a bit easier for the user to input all of these fields, and it automatically adjusts your cash flow off the back of those inputs. Cost and purchases, again, very similar to the net modeler. You can add a charge, maybe a particular pot. There should be a platform charge and an advisor fee. You can add that in here. And there's the annuity purchases nested up here as well. So if the client's going to be buying an annuity on retirement, you can specify how much of that pot is going to be used to buy that annuity, how much income is coming in, whether it's a level annuity or an index annuity. And again, that will give the system enough information to know how much tax to take off the back of the income coming in. So there are the different options. And as I said, all of those options taken together create these cash flows, saving over time, money in, money out, and that taxes tab as well. Now, yearly breakdown, as I've already explained, is a lot more detailed on the gross modeler compared to the net, because it takes into account all of those taxes. So each year, similar to the net, is obviously listed, shows you all the gross money in, the net money out, the expenses, the contributions, etc. If you open up any one of them, go into money in. These are the three lots of money coming into my cash flow: Keith's salary, Barbara's salary, and the money from the GIA. And it gives you then the calculation. So it's 70,000 gross salary, but then 13,000 of that is tax. So the net amount is 48,000, and explains how that is being calculated. So the income tax there. Exactly the same with Barbara's salary over here. And then the GIA regular withdrawal. Obviously, there's some CGT to pay. So again, the gross amount, the net amount, the amount of tax from CGT, and again, the actual CGT calculation underneath. You've also got money out, which are all the expenses, detailed and illustrated, all the liquid assets, all the contributions and withdrawals from that surplus income coming in for the pension. We explained earlier the two people on the cash flow and how much of that LSA remains. Kind of running total, and then insights. Anything out of the ordinary on any particular year will be signposted in here for you. So with this one, it's a unwrapped investment withdrawal. So there's a CGT liability, hence why it's just alerting you to that. But there are a couple of quite useful alerts. So a bond withdrawal, so maybe a chargeable gain. There's also ones for top slicing as well. And also if the money purchase annual allowance has been triggered, that will also show, which I think is that one. There we go, MPA triggered there. So some core differences. One last one to consider. We've come back to inputs and timeline. I just want to make actually I'll come back to cash flow model. If I want to make a duplicate of this cash flow, so I can make differences or enact some various different strategies, so I can compare A cash flow to B cash flow. I can click on this little plus icon. Again, exactly the same option as net. I can call this clone. Let's just call this cash flow clone. And again, it offers me the ability to do this on a net or a gross basis. So we're just going to do this on a gross basis. And I'm going to clone from an existing forecast. So my one existing forecast I had was called current position. So we're just going to duplicate that and clone it by creating it. And now I have two side-by-side comparisons. So I've got my current position and my clone. There we go. And they're carbon copies of one another, so they don't differ. And I've always got this compare tab at the very top, again, similar to net, where it allows me very quickly to compare one cash flow versus another. Obviously, there's no difference on these ones at the moment. So if I wanted to maybe make some adjustments to this and very quickly compare it to my current position, that's where this timeline feature comes in quite useful. So I can make changes very quickly on the fly. So the timeline feature under people and timeline, again, very similar to net and gross. It's just this mortality event that differs in the gross modeler. So just in general, the timeline feature allows me to make adjustments to my cash flow very quickly. So a good example of this is if I go to my incomes tab, you'll see a lot of the incomes, expenses, contributions and withdrawals. It expects you to put a start date and an end date. So if you look at Barbara's salary, if we edit this, you can see that Barbara's salary starts at 62, which is the start of the forecast, and it ends not at a particular age, it actually ends at the event retirement. I don't have to set it up that way. I could have just simply specified that it finished at 68 when she hoped to retire. The problem with specifying an age, if we wanted to quickly model out what life would look like if Barbara retires 3 years earlier, I would have to go into every single one of these inputs and change it from 68 to 65. So that's one of the benefits of adding it to a particular event. If I tether it to the event, it means, if I come back to this main screen, if I close that down, all the incomes, expenses, contributions, withdrawals, if it's tethered to the event, it means I can just simply go back to my timeline. And if I wanted to make an adjustment, I can just simply drag the timeline to 65 or retirement to 65, and it changes the calculations on the fly. So I can come back to my cash flow model over here. I can see now that the cash flow ends with a black hole of 224,000. So we can kind of start seeing what the cost of retiring early is, and then we can compare that very quickly and say, well, look, Mr. and Mrs. Klein, this is what life looks like retiring at 68. This is what life looks like if you decide to take slightly earlier retirement. Just stop comparing that. So that's in general what the timeline allows me to do, very quickly change the underlying assumptions nested inside it, so I can very quickly look at the differences between A scenario and B scenario. Let's just change that back to 68. Now, the mortality event is the thing that differs here with the gross modeler. You do have a mortality event in the net modeler. There's an extra little feature. It allows you to very quickly do survivor analysis. So if I add a mortality event in, maybe at 64, it will give it a name, mortality. We're going to kill off Keith Baker, the husband. The type of event is mortality. The extra little feature here on the gross modeler, it allows me to specify an insurance premium. So maybe his life is insured for 200,000. So there's going to be a 200,000 payout. And I can now save that into this cash flow. That's a new event saved. Now it's going to remind me all of the pots that that client has, and it's going to assume that all of those pots are just going to be handed across to the wife, Barbara. If that's not the case, you can actually signal it's going to be given to someone else, and then it would just disappear from the cash flow on death. But we're just going to assume every single one of those pots is going to be handed across to Barbara Baker on death. And I can click on Update Beneficiaries and continue, and it will then dynamically work that out for me. So when I go back to my cash flow model, it shows me that. So you can see the cash flow in the first 3 years is identical to what we had before. Suddenly the client passes away, all of the assets are transferred across to Barbara, and you've got all of the pots of money there. That's the inherited from Keith. That's the funds from Keith's ISA. That pot there is the funds from the bond being moved across. That's the insurance payout of 200,000. And this pot here is the investment account, the GIA, and that's the NS&I premium bond. And again, I can compare the two side by side. But again, because it's on the timeline feature, I've got the ability to go back to my timeline and say, well, this looks great. What does life look like if my client died when they were 72? Exactly the same logic. If we come back to my cash flow model, and again, you've got dying slightly later on. You've got the taxes tab as well that will look very different. Obviously, there's virtually no taxes to pay once all those assets have been handed across to the spouse. And also you've got the compare feature again to show what life looks like normally and what life looks like if one of my clients were to die slightly early and hand those assets across to their other half. So as you can see, there's a lot of differences between the gross and the net modeler. As I said at the very start of this recording, the net modeler is there for people to get used to cash flow. Very kind of a simple cash flow tool, doesn't take into account any of the complexities around tax. And the gross modeler, which now is the much more popular version, is there for a bit more kind of intermediate and sophisticated cash flow that takes into account, again, those complexities around the different tax implications of holding these different pots and taking various different bits of income. So hope you found that useful. Any questions, feel free to reach out to our help desk.